There are moments when markets do not signal stress through noise, but through restraint. Activity continues, transactions clear, and official language remains composed, yet something fundamental begins to misalign beneath the surface. The system still appears intact, but its internal responses no longer match its stated assumptions. This kind of shift rarely attracts attention because it does not disrupt routines. It emerges in subtle divergences, in instruments behaving slightly out of character, and in relationships that no longer move together as they once did. Most participants overlook it because nothing seems broken. Silver has historically occupied this kind of early warning position. It does not lead with drama, nor does it demand immediate interpretation. It reacts quietly when pressure builds elsewhere, reflecting strain rather than announcing it. What is notable now is not sudden movement, but persistence. Silver ES behavior suggests an adjustment to forces that are no longer being fully absorbed by the broader system. This adjustment is gradual, measured, and easy to dismiss. Quiet dislocation does not require consensus to exist. It unfolds regardless of whether it is acknowledged. When it does, it often does so through assets that sit between systems rather than within them. Silver exists in that space. It is both monetary and industrial, both liquid and constrained. When it begins to respond differently, it usually reflects pressure that has not yet found expression elsewhere. This is not a declaration of crisis. It is an observation of behavior. And behavior, over time, is the most reliable signal a system produces. The current environment cannot be understood through comparison to recent cycles because the system itself has changed. Over time, layers of intervention have accumulated, altering how stress is distributed and perceived. What once produced visible disruption is now often absorbed through institutional mechanisms. This absorption comes at a cost. Each intervention extends balance sheets, increases dependency, and narrows future flexibility. The system becomes more stable on the surface and more brittle underneath. Institutions respond to this brittleness by managing outcomes rather than causes. Policies are calibrated to prevent visible stress rather than to resolve structural imbalance. This approach preserves continuity but increases underlying pressure. Capital adapts accordingly. It becomes more selective, more cautious, and more focused on resilience than return. These shifts are incremental and easily misread as routine adjustments. Silver AS role becomes relevant in this context because it is less easily managed through narrative or policy. It responds to physical constraints, industrial demand, and monetary perception simultaneously. This makes it sensitive to pressure that other assets can temporarily ignore. The difference now lies in duration. The system has been operating under sustained strain for an extended period, relying on confidence and coordination to maintain equilibrium. That reliance changes how signals appear. Instead of sharp breaks, the system produces gradual distortions. Assets like silver begin to reflect those distortions because they cannot be fully abstracted. They remain tied to physical reality. This is why comparisons to recent years fall short. The system is no longer in a cycle of adjustment. It is in a phase of accumulation. History rarely offers clean repetitions, but it does offer structural echoes. When systems approach internal limits, their behavior begins to follow recognizable patterns. These patterns are not found in dramatic events, but in how capital, policy, and confidence interact during prolonged strain. One recurring precedent appears during late-stage monetary regimes when existing frameworks continue to function formally while losing practical credibility. In such periods, official assurances remain strong, yet capital begins to behave defensively. Instead of seeking growth, it prioritizes preservation and mobility. Assets that depend on long-duration trust quietly lose favor, even as they remain publicly endorsed. In these environments, silver has often reflected tension earlier than broader markets, not through immediate appreciation, but through changes in availability, demand structure, and participation. Its dual role as both a monetary reference and an industrial input makes it sensitive to subtle shifts in confidence. When trust and abstraction weakens, even slightly, silver begins to absorb that unease. Another historical parallel emerges during extended credit expansions. In these periods, leverage grows faster than productive capacity, and stability becomes increasingly dependent on confidence rather than balance. Policymakers typically respond by reinforcing narratives of control, emphasizing tools, flexibility, and resilience. These narratives delay visible stress, but they do not remove it. During such phases, capital behavior becomes more cautious without becoming overtly defensive. Funds rotate quietly, duration shortens, and liquidity becomes more selective. Silver's behavior in these contexts often appears disconnected from immediate economic conditions. Industrial demand alone cannot explain it, nor can monetary demand in isolation. Instead, silver reflects the convergence of both, signaling that the system's internal assumptions are being tested. A third precedent can be observed during periods of policy hesitation. When authorities face structural constraints, responses tend to slow. Decisions are deferred, language becomes more conditional, and interventions are framed as temporary even when permanence is implied. This hesitation is not indecision, but recognition of limits. Silver has historically responded to such hesitation by remaining compressed for extended periods. Suppression is not always deliberate. It often arises from the system's preference for abstraction over physical anchors. As long as confidence holds, physical assets remain secondary. When hesitation persists, however, the pressure does not dissipate. It accumulates. What unites these precedents is not crisis, but transition. The system does not fail abruptly. It drifts. Confidence erodes incrementally. Capital adapts quietly, and policy leans increasingly on perception management. Silver's role is not to predict the moment of adjustment, but to reflect the buildup of unresolved strain. These historical patterns suggest that silver becomes meaningful, not when fear dominates, but when trust becomes conditional. Its signals are subtle because the shift itself is subtle. They're easy to dismiss precisely because they do not demand attention. In every case, the lesson is the same. By the time signals become obvious, the adjustment is already underway. The most informative period is the one before recognition, when behavior has changed but narratives have not. That is the phase where silver has most often spoken first. The dominant signal underlying silver's response is trust decay expressed through liquidity strain. This is not a shortage of money, but a reassessment of reliability. Liquidity depends on confidence in counterparties, institutions, and frameworks. When trust is abundant, liquidity flows freely and invisibly. When trust becomes conditional, liquidity fragments. It still exists, but it moves selectively and defensively. This fragmentation does not immediately register in aggregate measures. It appears in distribution, in access, and in the terms under which liquidity is extended. Institutions adapt by tightening conditions rather than withdrawing entirely. Monetary policy operates within this environment by compensating for reduced trust. Facilities expand, guarantees increase, and communication becomes more deliberate. These measures stabilize outcomes but do not restore confidence. Silver responds to this dynamic because it is not a promise. It does not depend on counterparties. Its value is not contingent on policy credibility, but on physical existence and utility. As trust decays, even gradually, assets that embody finality gain relevance. This relevance does not require panic. It emerges quietly as a preference shift. The misunderstanding arises because trust decay is often conflated with crisis. In reality, it is a slow process. Silver's behavior reflects that slowness. The system responds by attempting to manage perception. Silver responds by adjusting to pressure. The divergence between these responses is the signal. Secondary signals reinforce the primary dynamic by revealing similar adjustments across markets. Bonds, for example, show demand that is cautious rather than confident. Duration is approached selectively, reflecting uncertainty about long-term stability. Currency markets exhibit behavior driven by relative resilience rather than strength. Capital favors flexibility, moving toward instruments that preserve optionality in uncertain conditions. Credit markets provide another layer of confirmation. Access remains open, but terms tighten quietly. Risk differentiation increases, indicating reduced tolerance for assumption-based lending. Metals beyond silver also show signs of repositioning. They do not surge uniformly, but their behavior reflects growing interest in tangible anchors. This interest remains measured. These signals align around a common theme: preservation over expansion. Capital is not exiting the system, but it is repositioning within it. Silver's response fits within this pattern. It does not act alone. It confirms what other markets are signaling more subtly. The coherence of these signals matters more than their intensity. Together, they suggest that trust is being rationed, not withdrawn. Silver's historical behavior under systemic pressure is characterized by delay rather than immediacy. It often remains subdued while confidence in financial instruments persists. This delay is frequently misinterpreted as irrelevance. In reality, silver functions as a pressure valve. It absorbs tension without releasing it immediately. Suppression mechanisms, both structural and psychological, contribute to this dormancy. As long as abstraction dominates, silver remains secondary. When abstraction weakens, silver's role shifts. This shift is rarely gradual once it begins. Repricing in silver tends to occur after prolonged compression. When thresholds are crossed, adjustments reflect accumulated imbalance rather than new information. This dynamic is why silver is often underestimated. It does not provide continuous feedback. It responds when the system can no longer conceal pressure. Hard assets more broadly exhibit similar behavior. They remain inert until trust dynamics change decisively. Their value lies in what they represent, not in immediate performance. Silver's current behavior suggests early-stage adjustment. It is responding, but not yet reacting. This distinction is important. When systemic pressure persists without immediate resolution, the response of institutions follows a familiar psychological pattern. The objective gradually shifts from correction to continuity. Stability becomes something to be managed rather than something to be restored. Governments, in such environments, prioritize social and economic calm. Communication becomes measured, carefully calibrated to reduce volatility and discourage reaction. Language emphasizes resilience, adaptability, and long-term confidence, even as short-term interventions grow more frequent. This is not deception, but risk management through narrative. Central banks exhibit a similar adjustment. Their frameworks evolve to accommodate strain rather than eliminate it. Tools are expanded, facilities are refined, and flexibility becomes a central theme. Each measure is presented as precautionary, yet the accumulation of precautions signals a system operating closer to its limits. Over time, these institutions become acutely aware of confidence as a resource. Confidence must be preserved, renewed, and protected. Policy effectiveness increasingly depends on perception rather than transmission. When outcomes rely on belief, communication becomes as important as action. Investors respond to this environment not with panic, but with adaptation. Risk is recalibrated rather than abandoned. Exposure is adjusted, diversification is emphasized, and liquidity is valued more highly. This behavior appears rational and orderly, masking the underlying reassessment taking place. Psychologically, normalization plays a critical role. Conditions that would once have triggered alarm are reframed as manageable or temporary. Extended intervention becomes routine. This normalization reduces friction, allowing the system to function longer than it otherwise could. However, normalization carries a cost. It suppresses feedback. When abnormal conditions are treated as normal, early warning signals lose their urgency. Adjustments are delayed because they no longer appear necessary. Narrative control becomes the primary stabilizing mechanism. Institutions coordinate implicitly, reinforcing each other's messaging. Markets internalize these narratives, responding to reassurance rather than to structural reality. This creates a self-reinforcing loop of confidence management. Silver and other hard assets sit outside this loop. They do not respond to narrative consistency. They reflect behavior rather than belief. As institutional messaging grows more refined, the divergence between narrative and asset behavior can widen. This divergence does not produce immediate instability. It produces quiet tension. Systems under prolonged pressure often appear most stable just before adjustment. The effort required to maintain confidence increases, even as the visible environment remains calm. Eventually, the psychological burden of maintaining continuity grows. Institutions face narrowing margins for error. Each intervention must achieve more with less flexibility. Confidence becomes increasingly fragile because it depends on uninterrupted performance. The key insight is not that institutions are unaware of these dynamics. It is that their mandate prioritizes stability over transformation. As long as continuity can be maintained, it will be. Silver's role in this phase is subtle. It does not challenge narratives directly. It simply reflects the cost of sustaining them. Over time, that reflection becomes harder to ignore. This is how psychological and institutional responses shape systemic outcomes. Not through sudden failure, but through prolonged tension between perception and if trust decay and liquidity strain remain unresolved, systems tend to undergo structural reordering. This does not necessarily involve collapse, but recalibration. Volatility increases intermittently. Markets adjust not to information, but to shifts in confidence. Liquidity becomes episodic rather than continuous. Institutions may consolidate control to manage instability. Oversight expands, flexibility contracts. These measures stabilize outcomes but can entrench fragility. Capital flows become more sensitive to credibility. Cross-border dynamics shift. Domestic systems face increased pressure to self-sustain. Silver and other hard assets tend to gain relevance in such environments, not as speculative instruments, but as reference points. None of this follows a timetable. Systems adapt unevenly. The process is shaped by behavior rather than intention. The persistence of signals matters more than their magnitude. Unresolved pressure accumulates. Silver's response is not a forecast. It is a reflection. It mirrors pressure that the system has managed but not resolved. Understanding this behavior does not require action. It requires awareness. Awareness of how systems communicate when they are strained. Quiet signals are often the most informative. They emerge before narratives adjust, before volatility appears, and before consensus forms. Silver has historically spoken in this way. It responds without urgency, without commentary, and without promise. The system may adapt. It may integrate these signals, or it may continue to defer adjustment. What matters is not the outcome, but the recognition that something has shifted, slowly, persistently, and quietly, and systems rarely ignore such shifts forever.